Everyone talks about using SBA loans to buy a business, but here's what most buyers miss. The bank isn't just lending money, they're evaluating you as much as the deal. One wrong move, the wrong industry, a shaky operator, or weak financials, and your loan gets denied before it even leaves underwriting. That's why I sat down with Craig Simon from First Internet Bank, one of the most active SBA lenders in the country. He breaks down exactly what lenders look for, how deals actually get approved, and why your personal story matters as much as the P&L, whether you're buying a $1 million plumbing company or a $5 million aerospace machine shop. These insights could be the difference between getting funded or getting rejected. If you're planning to use SBA financing, you don't want to miss this.
All owners must be U.S. citizens or LPRs. In the past, that wasn't the case. So that's a big change. The guarantee threshold is 20%, not 15%. Okay. So if you are a U.S. citizen or LPR and you're trying not to guarantee, you're not a material owner, you stay under that number. MCA loans, I don't know if that applies to anyone here, but basically that's the scarlet letter kiss of death now.
Yeah.
In the past, those loans were eligible for refinance. Now they're not. If you have one of those, you either have to pay it off before you apply, or you have to show you can cover the debt service, and most people can't because the terms are just so aggressive. Went through business school at USF. This was back in the mid 2000s. Jumped on and did their MBA program right out of college. Was, I think, the last class allowed in before they made you have a couple years of work experience. Nice. They're trying to bump up their numbers for earnings. So went through that, came out of grad school and went straight into banking school with Regions Bank up in Birmingham, Alabama. So up there it was, they put you on a 6-month rotation to do all different areas of banking, private banking, retail banking, commercial banking, and kind of figure out where you want to go, where you belong. Unfortunately for me, timing was horrible. This was 2008, so there wasn't a lot of action in the banking sector then. I think there was 50 of us that graduated out of that program, and it was more so like, hey, we're going to put you wherever we can, or we have to let you go right after we finish the program. So we all got kind of tossed around a little bit. So I started in private banking first for about a year, did retail banking for about 2 years, and then eventually landed in commercial middle market over in downtown Orlando, which was kind of my long-term home. It just took a while to move the chess pieces around to get there. So I was an underwriter for a few years out there. I really liked it. Wanted to be home at Tampa. I was engaged at the time. My wife was on this side. I was on that side. So it wasn't a great setup. So I went ahead and switched from Regions Bank, and I went to a community bank over in Tampa and was an underwriter there for a number of years, and then eventually made the jump into lending. So I started lending in 2015 conventionally, and I did that for a few years. And the bank I was at was trying to position themselves to sell, although they couldn't tell me that at the time. So it was one of those where, they started pushing the SBA products, and I had no experience. We didn't have an SBA program at the bank. It was just one of those things where, hey, Craig, do you think you'd be good at this? So let's go ahead and try it. So I did that for a bit, started to like it. They asked me to go full-time SBA. I said, no. They revisited it again. I said, no. Finally, they said, you don't really have a choice now. This is where we need you to go. And that was because they were trying to boost up the bank's income for a potential sale. So we did that. We grew an SBA team. The bank made some money, sold, and then, all those executives retired, took their cash, and then we were purchased by a credit union. And I don't know if you've worked with credit unions before. They're not great fits when they acquire banks. It's just a different culture.
Way slower.
The talent level is definitely watered down.
Very bureaucratic.
They're not driven to make loans. They really didn't care about profitability at all.
Yeah.
So it's hard, to try and advocate for clients and try to do business, stay relevant when your bank has really no desire to make money. It's a nonprofit.
Nonprofit, yeah. And it's incredible how they talk about like client experience or they call it member experience, but they don't care. So how is that?
Exactly it. It's exactly it. Like to them, adding a member for, a $10 checking account is just as important as a new member that with a $5 million loan. It's just a different speed over there. So, the writing was on the wall for our SBA team. So within about a year and a half, pretty much the entire team left. All of the lenders, some of the back office key personnel. And I eventually moved over here to First Internet Bank. So I've been here for about a year and a half now. Definitely like it over here. It's a complete 180 from the credit unions of the world. It's a very aggressive, pro business, publicly traded, very keenly focused on earnings. So, as a lender, music to my ears, right?
Yeah.
Just make loans, go out there, make
Yes.
loans. So that's been a great run. And, a few of my colleagues, they've landed at some other smaller banks, some of them down in your area. And no, it's been a good story so far.
So it's a good segue to ask because I'm a big fan of banks. I've spent 5 years in banking, and I love to kind of like learn the history of a bank and kind of like what makes banks tick, if you will. So, and always tell the guys, go meet a banker, ask the question, how they got there, how the bank got there, like the history of the bank itself, and what makes it aggressive versus some other bank. So as you're like, if you're talking to a group of people that are in the journey of buying businesses, how do you recommend, or how do you, what kind of frameworks do you give them to pick a bank to work with?
Yeah, I think it depends on how experienced they are. And then I
Yeah,
also think it depends on what type of business they want to purchase, right?
yeah,
Because like anything else, square peg, round hole, some banks excel in certain areas and some don't.
yeah,
Some banks want full collateral on everything, even a business acquisition, and they'll give you the best rates on the planet. And some banks don't care about collateral one bit, and they'll give you SBA par pricing because, one bank is portfolioing their loans, another bank is selling their loans. And, there's completely different speeds on how that works. Um, I would say, an important factor is having a good team, an advisor, even like some mentors, someone who can kind of guide you, especially if it's your first one, what to look out for, try to help on the negotiating side a bit. And then try to find a banker who's on board to working with you, especially in the early stages. So you can run numbers, you can look at potential scenarios. Hey, what if I do this? What does that look for, my potential loan structure? What if I do that? Sellers offering these terms, can we make that work? And just trying to kind of help mold it into a deal that would be bankable, so that you're not, as a buyer, you're not spending a lot of time, a lot of money, just spinning your wheels and hoping a bank, just takes it at face value. A lot of my clients, I say a lot, but a handful of my clients engage me pretty early on to look at different opportunities, and I can tell them with some pretty good confidence, like, hey, this is going to get traction, or, hey, here are the hurdles, here's how we need to mitigate those. And, give them some potential options on what they can do to make it a little bit more appetizing for the bank, or, try to bridge the gap for the seller and make it a little bit easier to digest for both sides.
got it. So you like to be engaged early on, pre LOI. That way you shape the LOI in a way that gets acceptable, lendable, if you will.
Exactly.
So give us some of the things that you look at when you look at an LOI. Where are the few things that you go to quick that you advise on?
Yeah. So for us, we our credit box is very transparent. So we basically have 6 guidelines, 6 pillars we look for approval. So we need to get 4 of the 6 in order to basically get an approval on a loan, or have at least a really good shot at getting an approval on a loan. So when I'm trying to look at these opportunities early, I first look at it from my lens and say, how many of these are we going to hit? How many of these are not even possible? And how many of these could we hit if we did X, Y, or Z? So first and foremost, for us, our bank here, we're very big on business acquisition. That's probably 90% of our portfolio. Where I came from previously, maybe less than half. They liked real estate, they liked equipment. It was just a different speed, a different credit appetite. Here, it's purely cash flow lending. So, collateral is not even one of the 6 items we look at. It's not even ranked as far as, when approval comes in, it's not even scored. So for me, I'm starting out with debt service. I'm looking at really the last 18 months in most cases, but realistically, it's the 2024 tax return, because the tax return always trumps, the financial statements, and then the year-to-date interim. So I'm looking to see, do I have at least a 130 debt coverage based on the proposed structure the borrower wants to do, right? And the 130 maybe sounds a bit high. Some people say we do a 115 or a 1.2, but keep in mind, our 1.3 is about as vanilla as it gets. We used to do a lower, like a 1.2 debt coverage, but we built in a proxy pass-through for taxes, or, we stress the numbers accordingly. Here is purely EBITDA or adjusted SDE against debt service. And it's very vanilla. So our 1.3 is probably what most people are saying is their 1.2. So I'm looking there first to make sure, hey, we have cash flow. I don't care as much about 22 and 23. A lot of that's post-COVID noise. really just looking at the most recent year and the current year to date, and just making sure, trends are held, revenues are where they need to be, the buyer's not catching a falling knife, there's not a problem. So that's where we start. So once I have a good feel for how the business can perform, at least, in the near term, then I'll start looking at who the buyer is in terms of, what they bring to the table, how they're a good fit. The things that we look for as part of our pillars, and most banks look for. So we're looking for, the guarantor that's going to be close to the business. It's tough to manage from afar. In the past, we've done it. My previous bank has done it. Statistically, those tend to not perform as well. Even franchises, certain franchises, they may have 3 or 4 locations and they're going cross country. A lot of times, the further they are, that those tend to get, the least amount of eyes, and, sometimes those are the harder ones to run and have more problems. So we like to see them within, an hour from the location, or if they're not there yet, they're willing to get an apartment. They're willing to be there to run it. We want hands-on management. I'm looking for some element of direct experience, or if not direct, do they have indirect transferable experience? Have they run a company before? How'd that go? Did they sell it? Did they make money on it? Was it a successful exit? Have they been in, are they an electrical engineer and now they're looking to buy an electrical company? There's some level of, hey, maybe they're not exactly this, but they're that, and there's some kind of crossover. That's always great. The next thing we'll look at is liquidity. We want to see that our buyers have some cushion, in the event that they stumble out of the gate for whatever reason, AR, timelines, works in process that don't transfer cleanly, just general volatility when transferring, into the new ownership role. Can they put food on the table? Are they in trouble? So we're going to look for some element of post-close liquidity. There's a ratio we'll focus on. To be honest, that's probably the hardest item to hit, is the liquidity in most cases, because if you were pretty, cash flush, you may not go SBA. But that being said, every once in a while we do have some buyers that have that liquidity, that helps us.
So what is that ratio that you're talking about?
So basically, it's gonna be their global debt service. So it's gonna be, let's say it's $1 million loan. It's
like
gonna be
personal
the debt service on that $1 million loan plus their personal. So their mortgage, if they have investment property, cars, that whole thing. Let's say the total debt service for everything is $250,000 a year. Do they have $250,000 in cash post closing?
Okay.
So again, it's a hard one to hit. I'd say less than 20% of our clients hit that one. That's fine. We still do plenty, that's usually of the 6. That's one
of the 6. That's one of the ones
that's the hardest one to hit.
Got it.
Yeah, it's hard.
Got it.
Once in a while, we'll get somebody who's just really, they had an exit and they're really cash flush, and and then they'll hit that one. But that one's generally the hardest.
Got it.
And then the last one, we're looking at their personal credit scores. We're looking for at least a 650. To be honest with you, in most cases, 680 is probably the number. Only because if you're at a 650, there's probably something on it, a delinquency or some issue that we have to, address. Maybe a previous BK from X amount of years, something like that. So that's generally our.
So let's go back. So 6 items. So the first one,
1.3 debt service.
The DSCR. Okay.
You got the guarantor that lives close to the business.
Okay.
Or is willing to move to be close to the business.
Okay.
Experience. Or transferable experience. The liquidity ratio.
Okay.
I'm looking at number 5. We talked about indirectly, but it's increasing revenue and profitability trends.
Oh,
so
yes.
Basically, the interim is on pace with the previous year.
And you're looking at just the 18 months. You're not looking.
Yeah, exactly.
Okay.
I'm really looking at, so right now I'll be looking at year to date, June or July. How does that compare to 24?
Got it.
Are we on track? Are we in the ballpark? Or, are things drastically different? Did the seller change the model, or did they lose a big client? That's what we want to focus on. Okay. And again, some of these things are going to bear out when the company gets valued, right? Because if you got a company that's showing 500K in SDE in 24, and now year to date they're way off track, the first thing the evaluator is going to do is going to jump on that and try to figure out what's going on, because it affects his multiple, which in turn affects his eventual value. So a lot of these things are tying in closely to what the business valuation companies are looking at. But in general, so that's our 6, and then the credit score. That would be our 6.
Okay, nice. That's pretty quick framework. And then so as you're looking at the LOI itself, what are you looking in the LOI?
So first, I'm just going to run the structure as is. If they have an LOI or they're proposing an LOI, I'm going to run it against our model right away and just see where it stacks up. How does the cash flow look? How many of these are we going to hit? What concerns, if any, do I have just from my initial glance at this? And then from there, I'll usually do a call with the borrower, or if they prefer email or text, whatever it is, a Zoom, whatever. We'll have some follow-up back and forth, like, hey, this company looks good. I like X, Y, or Z. Did you dig into this issue that I happen to see? Or, is there some seasonality in the business, or is there a timing issue because, if you annualize the interim, maybe it's not lining up as well as the previous, or, a lot of times you'll see those cash to accrual adjustments, or a lot of times you'll just see some wonky adjustments from a seller because they're trying to sell their company. So they're just adding back all sorts of stuff that, you generally can't add back. And then the next thing I'll do is try to look at, okay, in terms of add backs, how many of these do I think the underwriter is going to give us? And how many of these do I feel like we're going to have an issue with? And, in most cases, I would say, if we have cushion in the cash flow, generally, we can be a little more conservative on the add backs and still get it to work at face value. If we're really close on the cash flow, the options are raise more equity, one, seller note, two, or if the buyer is really bullish on this and the loan's big enough to warrant it, get a Q of E. And if we get a Q of E, generally we can take all the add backs in the Q of E because we could point to that third party report to substantiate those add backs. So if there's a lot of commingled personal expenses, or there's a lot of, maybe discretionary or, 50-50 type add backs, that's where Q of E would really drill it home for us.
Got it. Michael, you had the question?
No, sorry, I was just joining.
Okay, cool.
I was
just
figuring out my stuff.
If you guys have any questions, because Craig said a lot of things there, and you probably could go into each rabbit hole, add backs. So just talk about add backs. So give me your general, how do you think of add backs, and then what are the fun ones have you seen? And then what are the ones that are hell no, and what are the ones that most people say no to, but you can get through?
So a lot of it depends. I'd say last year, I think we were probably a bit more flexible on add backs. And then as the SBA program has gotten a bit more restrictive, especially come June 1, which I'm sure you guys know, we could talk about that too.
Yeah.
Definitely been a little bit tighter on the add back. So for the most part, I'm obviously taking the general add back. So, you have interest, depreciation, amortization, and then you have the seller comp. So, trying to do that SDE. So for seller comp, we're likely going to adjust that. So where I'm getting at is, if you have a seller, I'm looking at one now where the seller's taking close to $1 million in compensation. Seller does not need $1 million in compensation per year to live. So what we'll do in that case is we're going to look at the personal credit report and basically estimate what we think his living expenses are. So let's say they're $200,000. We'll add back the difference. That's $700,000. Conversely, if you're buying a company, seller's not taking any salary whatsoever, we're going to model in some element of compensation, because in the event that our buyer gets hit by a bus and the next person takes over this company, they're going to need a salary to run it. Even if my borrower has outside income, we're still going to include it because the business valuation company will include it. Now, where I have some discretion is if they do have outside income from another company or from property or a pension or whatever, they hit the lotto when they were 20 years old, whatever the case may be, I can omit the salary and make a case that we don't need it in terms of my calculation because we have outside income. Now, I do know the business valuation company will always put one in. So, a lot of times if we get too thin, they'll say, hey, business is just too expensive, once we adjusted it. There's any add backs that just scream they don't belong. I was looking at a gas station acquisition recently, and they had personal vehicles and stuff in there. You don't need that to run a gas station, so some of those are fairly easy ones. The ones that get a little tricky is, when they have 15, 20 different little add backs in there, their personal insurance, their kid's cell phone, all this kind of stuff. And in this case, it's just our underwriters just frankly don't want to try to Frankenstein their financials. A, they're really not equipped to do it.
Yeah.
B, they really can't go through and check it on bank statements. It's just too much of a time-consuming exercise. So in those cases, if we need them, that's when I'll say, hey, go get even a light scale Q of E, get one done. And that way we can point to the underwriter and say, look, peak business valuation did this Q of E, and here's 185,000 in add backs that normally we really couldn't give them just because we can't prove them.
Yeah. So you rely on, that's pretty good insight right there. You rely on the Q of E to kind of help go through the bank statements and then really flush out those, that personal pool that you put in the back of your house. That's not
exactly right. Exactly. And there's all sorts of stuff in there. Yes. And you don't always need the Q of E. I mean, if the numbers work on the tax return in the interim, I'll tell the buyer, hey, you can get one if you want it for your own due diligence. And I recommend it, but you absolutely don't need one. We can get the loan done without it. So it's a case by case. just depends. And then your other question about if I've seen some fun ones,
Yeah.
we've done some interesting ones where, it was like a company was carved out of a larger company. Those are a bit trickier. But yes, we've done those as well. And a lot of times, in those cases, QV really can't help you there either, because you don't really know
No,
how
yeah.
much,
Overhead. Overhead,
salary,
can you allocate?
overhead, and overlap.
Yeah.
It's too
Yeah.
commingled. So in those cases, we have done, we've reached out through the buyer, of course, but then we would get, maybe like a letter from the company CFO or maybe their accountant, just saying like, hey, these expenses are generally tied to maybe this subsidiary, and vice versa. These really don't belong here. So there's a little bit of a leap of faith there. On those, we'll definitely look a little harder at the guarantor and their skill set. And if it's something that fits with what they've done this in the past, or they've done repositions before, we'll give them, a lot of times we'll give them at face value and say, hey, look, yeah, this makes sense. And, we trust that, your analysis is fairly complete here. But yeah, a lot of that's case by case. Again, I prefer to not do the QV. They're expensive. It's just another hurdle to clear.
Yeah.
So I'll try to steer the borrowers, into the structure that I think will get done, with the path of least resistance if we can.
Okay. And what have you seen? Like, obviously we went through COVID. It was, everybody was flushed with cash, and then we had this whiplash post-COVID with the rates going up and so forth. Like right now, we're kind of in a normalization phase, if you will. What have you seen kind of like that trend for, let's say, talking about 2024, because you're seeing 2024 numbers right now.
Right.
And a lot of people are kind of like a little bit wobbly. They look a little bit wobbly. So what have you seen, and how are you making those deals work?
Yeah, it's been a mixed bag. So post-COVID, there was a lot of, like you said, volatility, good and bad, depending on industry. I would say there was a lot more of seller notes on a lot of deals, whether that was just buyers insulating themselves or banks pushing for that, or combination thereof. And there was more flexibility to make it work. Obviously, come June 1, they've changed that standby period and some of the dynamics there, and that's made it a lot harder to get sellers on board. So I've seen, borrowers have to raise more equity or dig a little deeper to pull these off. That's been a bit of a focus. Again, certain industries haven't been as impacted. There's other ones, the tariffs now, that's starting to rear its head a little bit more, depending on, what industry they're in, where, maybe the 24 numbers look really good. And now, even the interims are good, but they know there's a little bit of a storm on the horizon, in terms of what they're going to pay for goods and their materials.
What industries are you seeing that?
Retail, a lot of stuff that you're seeing from India, China, sometimes e-com to a degree, a lot of stuff where they're, you're having to move the product back and forth. In the beginning, there was just a lot of, we're not sure what this means for us. And I think there was a lot of sellers that may be motivated to get out before they had to fully understand what those impacts were going to be.
Makes sense.
So those industries, lately I've seen, I don't want to say stress, but I've seen less activity with service-based companies. A couple of years back, those were really, really hot, borderline, recessionary proof, because people can get labor. Now, depending on what industry you're in, there's less of that out there, especially if you're in like landscaping or, any kind of those heavy construction industries. There's just, the workforce seems to have either left on their own or, or just because of, what policies are in place now. So, I've seen those opportunities be a little more challenging, only because, again, the numbers have been a little choppier there. Whereas,
but I think also that's also a part of that liquidity. People were flush with liquidity, so they were putting out, $250,000 pools, like like there's no tomorrow, or like 150K in landscaping, or remodels. So everybody now is like slowing down on those big projects. So a lot of the people that were heavy, design and build industry have seen that, those large projects, or even like the small size, mid-sized projects, are kind of slowing down. They're not coming through as fast as they were. So 2024 has been tough.
Especially anything tied to homes too. I mean, you see, depending on what area you're in, you're in Florida, I'm in Florida. Things have gotten a little slower here. Texas has kind of followed suit there some. And one other thing too, there was a lot of foreign outside money coming in prior to June 1. And I would say, especially I do a lot of deals in South Florida and Miami, and that's very well connected internationally. And I would say, a good percentage of those loans had, an investor from South America or from Europe or something along those lines. Now that's no longer allowed, unless, or at least not allowed in terms of as an ownership level
Yeah.
with the June 1 changes. So again, some of those opportunities where maybe, they were willing to put in the extra cash just because it was a safe harbor for, maybe whatever their economy was in Ecuador. They say, hey, I'm going to invest in this company with my friend or my cousin or whatever,
Yeah.
because I know it's safer than keeping it here. Those have obviously have dried up. Given
So
the
let's
change.
talk about that. You cannot be an investor whatsoever if you're not a
So you just
citizen or a
you can't
resident.
be an owner, right? You can't be an owner. So in the past, 51% had to be a U.S. citizen, LPR.
Yeah.
Now everything down to the decimals. Because we had deals that we had like a lady who was a 0.005% owner from Belgium. That
Yeah.
deal would not be eligible under the new SOP.
Oh, wow.
100% has to be U.S. citizen, LPR. That was one of the
So how do you
administrations.
go? Is there like an investor class, or like is there like a state status that you can do to take the money but not be an owner?
No, I don't know. I mean, I think, a lot of times there's been some maybe reorganizations on some of those companies. I think there's a look back too with the SBA. I want to say it's 6 months. Some of them are just, hey, you're just not eligible, and they'll
Oh,
just
well,
regroup
some
and go from
reason, for
there.
some reason, like we had this conversation in our chat literally just this week. Someone had a Canadian investor that he was going to bring in, and we thought that you could, as long as they don't have to be PG, as long as they're under 20%, they could still be below 20% owner. But you're saying you can't.
No, you can't. So
Oh,
when the
wow.
packager goes to pull the E-Tran authorization at the end for closing, they have
Okay.
to input 100% of the table on who the owner is.
Wow.
And if someone is not a U.S. citizen, they're not
Well, let's
eligible. So
talk to
that
the
banker should flesh that out before they get too far.
Wow.
Just a
Okay.
heads
Let's
up.
talk about those changes because I'm hearing a lot of stuff. Like for example, the PG got to be 15% now, not 20. And so just give me what you got in terms of the change because I think
So
the
the big
changes.
changes, the
I
key
think the
changes.
changes are changing too.
Correct. And they're continuing to change. Yeah. So we'll just go off of what happened as of June 1 and not what's getting kicked around right now. There's
Yeah.
a lot
What
of
we
things being kicked
know.
around.
Yeah.
So as of June 1, threshold is 20%, not
Okay.
15.
Okay.
So there's that. So if you are a U.S. citizen or LPR and you're trying not to guarantee, you're not a material owner, you stay under that number. MCA loans, I don't know if that applies to anyone here, but basically that's the scarlet letter kiss of death now.
What's
If you have it,
MCA?
that's that merchant cash advance. So
Okay.
let's say, where they basically take money off your future income stream, off your POS system.
Yeah.
In the past, those loans were eligible for refinance. Now they're not. If you have one of those, you either have to pay it off before you apply, or you have to show you can cover the debt service. And most people can't because the terms are just so aggressive. It's
Yeah.
40% interest, predatory lending stuff. So
Wow.
those basically, if you have an MCA loan, you're kind of out of luck at the moment. That's been a tough one for a lot of borrowers. The other big changes were partial stock buyouts, stock purchases. Previously, you can keep the seller on at 1%, no guarantee. Helps if you need their license, or it helps from an experience perspective. Now, if they stay on, they have to guarantee the loan for at least 2 years. That was a big change that affected a lot, especially in the BizAc world.
Yeah.
The standby rules, which we mentioned earlier, previously was a 2-year standby period to count as equity for a new buyer. Now it's 10. Again, harder to swallow. We'll still see some of that. Definitely less, but that's out there. This one is a bank policy for us, not an SBA policy, but we do require the equity to come from a U.S. account. It can't come from London. It can't come from anything like that, even if it is a family member, only because we were so sensitive to the changes with the ownership. The higher ups decided that until there's clear rules on what they want going forward, we want everything to be domestic in terms of where the funds are coming from. So I mean, now if you do have money overseas, move it here sooner the better, obviously. The other big one was licenses. So again, in the past we had the seller, if you needed a license, say an HVAC or medical or plumbing or whatever, you needed a license to run the company. In the past, keep the seller on 1%, that covers you. Now sellers don't want to guarantee, so that's an issue. So, for us, we've come up with a couple things that we're going to do. And again, every bank's treated this different. Some banks will completely pass on companies with licensing just because of the red tape.
Oh, wow.
For us, we'll allow the seller to qualify the license as a consultant for up to 12 months with the caveat that the buyer can get the license. So, if I'm a banker and I'm buying, a physician's practice, I can't get that license. That one's not going to fly. But if I can sit for my GC test or I can sit for my plumbing, that works. The second option is if you're buying, let's say, an HVAC company and you don't have the license, if there's someone who's in the company already, like maybe a foreman or someone that's been there that has the license, give them 1% ownership. That covers us. They don't need a guarantee. We can show that there's a qualified license holder tethered to the company. Maybe a little bit of upside for that foreman to stick around too, because they have some percentage of the business. It's not terribly much to give away. That works for us. The other one is if you don't want to give that foreman ownership, you can still use the license, but that foreman needs to PG the loan. So they're probably not going to do, unless maybe you give them some kind of contract, maybe a big fat salary, maybe he'll PG it that way.
So if they have ownership, small ownership, they don't have to PG. If they don't have ownership, they have to PG. That's interesting. Okay. But
this is your bank. We want to tie them to the business somehow.
Got it.
So if they have ownership, they're tied. If they don't have ownership, how do we tie them? We make them PG.
Makes sense. So, okay. And it's not a 1 year thing. It's unlimited. Okay.
It's unlimited. Now, if the buyer gets the license, let's say 3 years down the road, sits for the test, and you want to release that, at that point, yeah, we can do that because we're covered. We just need to do a change memo. But we're just trying to plan for, we don't have to touch the file a million times. It's like, hey, closed, go run your business and we'll try to stay out of your hair, make your payments. You won't hear from us ever again.
Okay.
Unless you want to hear from us, of course.
Nice. So these are, so let me go back one step. Do you guys hold these loans in your portfolio or do you sell them?
So we sell. So yeah, I can talk about that too.
Yeah.
So it depends on, which bank. So some of the larger banks, let's say BOA, Chase, they're likely going to portfolio. I don't know if you work with Bank of Tampa much.
Yeah.
They're a great bank here. They're going to portfolio as well. What that means generally is they have a little bit more discretion on the pricing. Generally, you'll get, they'll offer you better pricing. But the other side of the coin is that their box is very tight. So, they'll want the collateral, they'll only work with certain industries, they'll be, very keen on, who the borrower is, the direct experience, it's harder to get those approvals. So
tighter box.
Tighter box. And the reason being they're looking for a less risk profile in their portfolio. They're willing to do prime plus 1, maybe prime plus 1.5, because they're not selling it. They're just keeping the guarantee as an extra enhancement to the credit, and they're getting the interest spread. The other banks out there, which I would say majority banks out there, probably 80% of the banks out there, they are using the SBA program and they're selling the loans. So what that means is, we will price at SBA par pricing. The max is prime plus 3. My last bank priced everything at prime plus 3. We'll do prime 275. In certain instances, we can go less than that, especially if it's a real estate purchase or something where there's a longer amortization. The bank makes more money on the sale.
Yeah.
But let's just say everything is prime plus 275. What we'll do, and most banks will do, is we'll package up the guarantee for that loan and maybe the other 25 we close this month, and then we'll sell it in the secondary market as investment paper. And then the buyers for that would be, Raymond James, hedge funds, retirement funds, and they're basically using it as like a government bond essentially. That's how most banks run their program, and the SBA program is a fee driven program for the bank.
So if you're selling that loan, are there any covenants in the loans that have to be there for it to be sellable?
No. So that you can't. The SBA does not allow you to put any covenants in.
Got it.
Really, realistically speaking, the only default is really a payment default. Now that you can't change ownership, and there's things you're supposed to alert the bank on, but it's not like a conventional loan where every quarter they're testing your leverage or they're testing your debt service, or they want, they're doing borrowing base on what your AR report looks like. None of that stuff. So basically, banks, and ours included, we will close the loan, compliant with SBA standards, and then those guarantees are packaged up and sold.
And you're still servicing the loan, or
someone? Still service the loan. I'm still your lender. You still make your payment to the bank. You can still bank with us as well. Yeah. We're still the face. But yes, that's how it works behind the scenes. And there's a market there, and it's these loans will trade depending on different factors going on with the economy. And there's a premium for the sales. And the bank strategically will sometimes sell, sometimes hold, just depending on what they have going on. Just internally.
Okay.
So that's the interesting part about the SBA.
Okay. Brian, did you hear that thing about international investors? Brian was the one.
Yeah, I had to jump off for a second there, Jay. So are you saying that even if they don't sign up for personal guarantee, can they still have ownership, or they can't, period?
They can't. Now, I guess the one caveat here is that maybe if you're whoever you're using, if they're portfolioing the loan, maybe they're, if they're not selling it, maybe they're going to be comfortable doing something a little bit outside the box. But in general, no. Everyone has to be, every owner has to be a U.S. citizen or an LPR.
Okay.
So is that so if it's an SBA requirement, then even the portfolio lender can't.
They're supposed to follow that. Yeah.
Okay. So they're usually not, they don't have that optionality to, if they want to keep the guarantee.
But they want to keep the guarantee. If they're willing to roll the dice on the guarantee, they can do what they want. But 95% of people are going to, make sure they check every box with the SBA.
Yeah.
Otherwise, why use the program?
Okay. Yeah. This was new to me. I didn't know. Okay. So what are some of the things that you're seeing right now in terms of like creative structures to kind of like alleviate with all this change that's happening, both in terms of like the SBA rules as well as what's happening in the economy right now?
The only thing I'm still seeing in terms of creativity is, there's still a pretty good amount of forgivable seller notes out there. And I don't know if you guys are played around with that, but essentially, if the buyer is bringing in the 10% or, they're bringing in the 5 and the seller is doing a standby note for the other 5, there could be a B seller note that says, let's say it's a $500,000 note. If revenue doesn't hit X next year, maybe 25% is forgiven or 50% or all of it's forgiven.
Yeah.
Those are a bit more creative. We still see those.
How far out do the markers for forgivability go? Is it normally like 12, 18, 24 months, or do you see some that are like 3 or 5 years?
I have seen some that are longer term. Again, sellers are less likely to agree to those just because it's so far out of, their purview that, they don't really have to put a lot of faith in who's running it. In most cases, it's in the shorter term. It's in the first, year to 2 years that I've seen those work. And again, case by case, it depends. And a lot of times, that those come into play where maybe the seller was saying like, hey, I have this new line of business coming on or that I didn't have previously, and it's going to add this much to the company. So, the buyer will put that in as a bit of a safeguard or,
Well, that's exactly the scenario that Michael has right now.
I'm in a really long sales cycle
Yes.
sort of business where they're like, oh, here's something that we started selling 18 months ago that'll be a 24-month project.
Yep.
And so it seems like that's the right sort of solution in my case.
Yeah, I think that usually is the right solution. Again, you want to take it at face value, but at the end of the day, you're buying it based on what it has done historically, and you're hoping for the upside. You're not buying it, based on the upside. So, that's where that structure will be helpful. So, those creative structures are still in play. Beyond that, I haven't seen anything too great that would wow you guys. A lot of it is pretty vanilla, especially post June 1. Just for us, I can look at a couple of the ones we've went through recently. We'll do some pretty niche based stuff. I mean, working with a company now that has high levels of seasonality where all their revenue is earned in, 1 or 2 months during the year. We'll do not a lot of, we're open to, just working capital loans for existing companies to expand, maybe add new markets or, grow that new line of business. We're doing some of that. We're open to startups. Doing a handful of those now, gyms, franchises, restaurant, again, case by case, who the person is, look at the demographics and what they're trying to, open up.
What was that business, the seasonality business that's 2 months? Is that a Halloween store or fireworks?
No, it's
4th of July fireworks.
Government contractor of all things.
Oh, really?
So, yeah.
That's interesting. What kind of contract?
Wildfires.
Oh,
So,
interesting.
a lot of their business is, the fire season is
Very seasonal.
it's kind of like hurricane season in Florida. Yeah. And then the contracts and,
Is it in California or is it
Yeah, well, it's all over, but yeah, mostly on the West Coast.
Okay.
So wherever the wildfires pop up, the government will deploy, multiple companies to go out there and help with those efforts.
And there's just like a logistics, or where are they involved in? What is the actual service to the government?
So really, it's just sending people, ambulances, firefighters, kind of like traveling nurses. It's like sending them where they're needed. So just stuff that you normally wouldn't even think about. Just interesting interesting things.
And how do you deal with that? Like, for example, we had someone who had like a government contract situation. How do you deal with that in terms of, so in this case, you have the seasonality piece, and
Right.
then you have the actual getting the, like the renewal of the contract. If there's,
Yep.
so how do you deal with that part,
Yeah,
that
that's a
risk?
good question. So for us here, it's really just trying to understand how the contracts work. The underwriter did a pretty good job in trying to give them a few like, what if this happens? What if that happens? Again, we can't 100% know that they're going to get the contracts every year because they do bid. But it's just, hey, they've got it for the last 8 years, and here's generally where they rank on the list. And if they wanted to rank higher, they would do this, with their pricing. If they wanted to rank lower, they would do that. So just getting comfortable with the model again. A lot of this is you have to put some faith in who's operating the business and and their ability to continue to do so at a high level. I've also been a part, not at this bank, in a previous bank where there was a government contract, but it was for like top secret procurement of materials for like submarines and such. And not only can you not understand, you can't get a lot of details on what the contracts are. So then it gets even more tricky in trying to understand how you can forecast cash flow. But usually, we'll try to do a call with the underwriter in that case and just have the borrower just kind of walk through it because they're going to know it better. Even if you get those government contracts, they're 700-800 pages long. And if you're not in the industry, it's really difficult to navigate how those work. So a lot of that is, again, just kind of having some trust in who you're doing business with.
That's interesting. So the underwriter gets in enough weed to understand the business, but not deep in it because it's just impossible.
It's impossible to go down the rabbit hole and understand it all the way. So, that's when they'll say, okay, well, let's look at the person, great credit scores, they've had, good years of performance. It's like, hey, we think they're going to continue to do well. Maybe we can't get our arms around every aspect of this, but we feel comfortable enough that there's enough here.
Okay. What about post-acquisition loans? Do you do
in terms of
those? Like, somebody, I'll use my own thing as for example. I'm not doing SBA for a variety, one for speed, but another big reason is one of the two owners is going to stay on for like 3 or 4 years because they're special. And so it just doesn't work.
Right.
But I think that in the next 12 months, I may want to open up a new facility.
Yep.
And so I'm sort of over equitizing up front.
Gotcha.
Do you all do much of that, or do you think the SBA is effective for that?
Definitely. Programs? So, and if I'm misunderstanding, so you can't recapitalize and refinance, your deal, but you can do, and we do this plenty, I'm doing multiple right now. We can give you $1 million to expand into a new market or get a new leasehold facility or buy a new building or hire 30 new people to grow this team. All that would work. What we would do in those cases, we're going to look, how you've performed since you've taken over. And then we're going to look at, what's on the horizon. Maybe you have interest from some clients that, hey, we really want to do business with you, Michael. And, we're can't give you a contract, but we're open to, maybe this type of setup. We'll use that as kind of a sign of good faith. So it kind of depends. We've done ones where, hey, they'll cash flow historically for the most recent year in 6 months, and we'll just give them the working capital and say, go get it. And then there's others where, it's all forecast, all projection. And then that's where we'll lean heavily into the assumptions on why it works, why it makes sense. And then we'll go that route. So, not a perfect example at all, but like a reposition of an asset, like an assisted living facility. So maybe you bought an assisted living facility and you're re-tenanting the place or whatever the case may be. And, it's not going to be stable currently, or maybe it hasn't been for the past few years because the rents were under or it wasn't run properly. In that case, we're going to look at the forecast, the assumptions, who's driving now, who's on it, and then what their plan is. And then we can do the loan that way. So,
and then the terms are the same as the other 10-year prime plus personal guarantee.
Correct. It's the same standard SBA fare. The only time it's different is if there's real estate involved. Right. Real estate gets you the 25-year AM. If it's 51% for real estate, if it's less than 51, they'll blend it. So you wind up with like a 13-year or 17-year. So it just depends on what you're doing, what the use of funds are for the project.
Yeah. But okay. So that's interesting. In most cases, they're leasing their production facility right now, but if I say, hey, we're doing a big thing and we want to expand in there, and I go and actually maybe buy the production facility.
Oh yeah.
Outright.
Definitely.
Okay. That's interesting.
So I have one now where a company has, hardscaping, landscaping, and they want to buy a property and do a nursery. Well, maybe the historical numbers aren't there yet, but once the nursery is open, it will be. So there's a new business model as well. There's a new revenue stream that we need to take account for. So Those are circumstances where good business plan, good assumptions, good projections, that's going to be really the meat of the loan.
Yeah, that's helpful. Thank you.
Yep.
I quick ask a question I probably should know the answer to. So I'm in the manufacturing space, Craig, looking to buy some manufacturers, and it's my understanding that the limit went from 5 to 10 million. So I could purchase two $5 million companies, correct? Like my limit is 10, correct?
Yeah, so it hasn't officially happened, but it's going to happen. I think it went through the House, it needs to go through the Senate, or vice versa. All signs are it's going to happen. What we don't know is when it takes effect, whether it's day one or whether it's, the next fiscal year, at the end of September. But yes, you would have 10 million. And my understanding, again, limited details so far, is you could either do that via one NAICS code or multiple companies. So
okay, and if I'm 50% owner, I still though am assuming that 5 million, right?
Yeah.
Okay.
Yeah, I think that would still count for you.
Okay.
Correct.
Cool. Thank you.
They still haven't announced all the details on that, so take that with a grain of salt. There's more to come on it. Again, it's a big push from the new administration. I imagine they're going to be pretty friendly, and because they really want to tout that as keeping it here, manufacturing America, all that. But that's what I would plan for. Just wait until it's officially approved before you put any hard money up against it.
Cool.
A quick question on the collateral. We get this a lot because we have, a lot of people with who are real estate investors who have real estate property as investments, or sometimes have unrelated businesses. In order for them to prepare for an acquisition, how do you recommend they kind of if they don't want to put those assets as a collateral for the SBA loan, what do you recommend ahead of time?
So generally, if there's not a lot of equity in those properties, the SBA won't require us to take them. So, if those properties have debt or HELOCs on them and there's not a lot there, it's not worth the trouble with title and going through the whole thing. And we don't have to take it. We don't want to take it if we don't have to take it. We're not the bank that's looking for, all your property. We're looking to just comply with the SBA program, and we're purely cash flow lenders. So, if you have a lot of assets, it's, and you're trying to shield, again, the SBA doesn't like that, but at the same token, if there's debt on them, that may be a circumstance where it benefits you. And, and sometimes in my seat, I like seeing when there's a HELOC on a property, because that's extra liquidity they have available if they need it, Number one reason why businesses generally don't make it is they get cash flow pinched. It's not like, they bought a bad business or they're bad operators, just something happens, they get stuck, and then that snowballs into a problem. So, if you have investment property or you have a property or equity, get that HELOC and keep it there for a rainy day. Keep that dry powder, because I'd rather you have that than not.
Got it. So outside of HELOCs, anything else? Put it in a trust, put it in this, put it in that.
Trust doesn't do, because they're going to see who the beneficial owner is. So the trust won't help you in that regard. Now, if you're less than a 51% owner of the property, let's say you own it with your sisters and brothers or something, then the SBA won't take it. So there's those types of things.
How about like unrelated businesses?
So it depends. The SBA has an affiliate test, and it's always fun to figure out what they deem an affiliate or not an affiliate. I've had some instances where they're like, this is not related at all, no problem. And I've had others who are like, hey, we're relying on the income from this business to make the cash flow work personally, so we need that business to sign on. So it kind of depends on how tight the numbers are. Depends on the underwriter in some cases too, and their interpretation of what an affiliate is, or how that global cash flow ultimately shapes out. But that's something to consider as well. I always would say plan to have it included. Don't offer it up, of course, if you don't need to. But save that card if you need to play it at the end. Got it.
Okay, that's interesting. Any other in terms of like the pinch piece? What is your advice? The way I tell the guys is get as big of a line of credit up front as you can. Get as much working capital as you can. You don't have to use it, just have it. Because that first 12, 18 months, usually it's the challenge the business is the J curve or S curve, whatever you want to call it.
Absolutely.
So why don't you speak to that a little bit?
Same here. I mean, I want to give as much working capital as possible, because ultimately I want you to have too much, because I want you to come to me a year from now or 6 months from now and say, hey, I have too much cash, I want to make us pay down to my loan. I never want you to come to me and say, I'm in trouble. Again, those first 18 months are critical, even from the banking side. I mean, any type of request for help or deferment or problem is basically an early default, in the eyes of the SBA within the first 18 months. There's not as many tools to help you until you get past the 18 months threshold. So yeah, you're right. Take as much working cap as we can get. Take the line of credit. And the nice thing is when you're buying the company in this case, you're using the seller's numbers to get these things.
Yeah.
So take it as much as you can because in those first 12 months or so, it's going to be hard to get another loan because you don't have a tax return yet. You don't have that track record. You can prove that, hey, I'm running the company officially. You may have a good 6 months or something, but it's tough. It's tough to go back to the well so quickly. So yeah, try to get as much as you can. Try to max out your loan as best you can. And again, if you have too much cash, make a pay down.
Yeah.
It's a small price to pay for that peace of mind to make sure.
So you mentioned earlier, the nursery. We have a couple members that are looking into nurseries down in the Homestead area, and then there's the element of there's the real estate, there's the inventory of product, and then there's the business itself. What have you seen those deals? How do they get structured to actually be lendable?
Yeah, so just in terms of inventory is a tricky one because it's a moving target. So if your question is going down that road, and I've seen this on the retail side, and and anything, even from like marinas, where they're selling different items. Usually, what I recommend is when you're putting the LOI together, try to have like a minimum target of inventory. Like, hey, business comes with $250,000 of inventory
included,
and then included, and if it
falls
below that.
So the 200,000 that you're talking about, is it part of like your working capital, if you will, like as part of your calculation of the whole thing? It's the inventory, the WIP, the receivable, whatever it is, whatever you're gonna need, you want to have that inventory to be able to start the business. That's part of almost like a working capital of the business. Okay.
Yeah. So like when we're doing a loan like that, we'll break it down. We'll do like the business acquisition, we'll do the inventory, we'll do the working capital, and then of course closing costs. And if there's anything else needed too, if they're buying a forklift or something, we'll build it all in and itemize it all out. But in terms of the inventory, when you're transitioning the business, that's where it's a little tricky because the seller is trying to not buy inventory, save the money. Buyer needs inventory and doesn't want to jump in the first day and not have anything to sell. So I always say try to have a targeted number. I've seen them, like I had one a while back. It was like a countertop company, and they had a minimum inventory number, and he wound up getting far more inventory than he thought he was getting. The seller just gave it to him, which was amazing, which was beautiful. The tricky part as a lender is like I can't change the loan amount at the end to pay for that additional inventory. So if there's a target, hey, give me 250,000 at closing. If he winds up with another 300,000 inventory, maybe they'll work something out down the road to buy it from him, or maybe the seller will sell it, or whatever the case may be. We just can't change gears. It's kind of a slow moving ship. So once the loan's approved, I can't instantly change and add another 250 in. Otherwise, I would tell you to just take it on the front end. Take the 500 or whatever number you're comfortable with.
So why would you change in that case? He's giving them the inventory for free.
A lot of sellers won't do that. They won't get it for free. They say, hey, I want you to pay me more now because I'm giving you more inventory. So I try to say, hey, just hit this minimum number, and then that way you're covered. And then if he gives it to you, great. If he doesn't, maybe you buy it from him down the road. Once business allows.
Got it. And then what have you seen the structure where, like a lot of these businesses have been running for a long time, the real estate piece was, they were not accounting for a big rent, or they were not charging themselves rent at all.
Right.
And then they want to sell the business with the real estate, and then the real estate got inflated the last couple of years. How have you seen those, work themselves out at the end?
Yeah, that's a good question too, especially down in your area. That tends to be, you see those numbers sway wildly. I had a couple of those too over the years. So the first part of the question is if they're not charging themselves rent, we're going to try to model that in. Now, if they're going to buy the property, then we'll look to do the blended term or the 25-year term. And we're just going to run the whole thing just based on the same numbers and see what we come up with on debt service. If that delta is large, or the property in Miami used to be $1 million, now it's $10 million, it's not going to work. A lot of times I'll just say, hey, work out a lease with the seller, first right of refusal to buy it. Maybe in 2 years, you can just get conventional on that. You know what I mean? And as you guys probably know, national average on SBA loans is about 3.5 years, and then clients will graduate out or refinance, sell, whatever the case may be. So I wouldn't anticipate you being in the SBA for the long term, but if you have that first right of refusal, if you need it, you can do it, but try to get conventional if you can, just because it may not fit with the SBA.
How quickly can you refinance out of an SBA?
How quickly can you refinance at
Yeah.
SBA? As quickly as a conventional lender is willing to do it.
Oh, so it
In
doesn't
my
matter.
experience, yeah, there's no, my experience, most people want 2 to 3 years. They
Okay.
want those tax returns. You know, I
So
haven't seen anyone refinance less than a year.
does it make sense? Does it make any difference if you did a stock sale, so you still this entity's still there, so you have the old taxes, or no?
It's up to that lender. I would
Okay.
say, they likely want to see what you've done, but if you find a lender willing to do it, I mean, you know, depends on your circumstances too. Like I have one where this guy was a certified rich guy and he started down the SBA path and he said, "How do I want this proctology exam?" And he just put more down and went conventional right out of the gate, and
Mm,
they just didn't care. So it depends on those circumstances. Those are less. You don't see those as often, but
got it.
occasionally you do see those.
Which lenders are the biggest refinancing lenders for your stuff?
Always changes.
Oh,
Depends on
really?
how hungry the banks are. So it
Who
always
is
changes.
who is that lender these days?
That's a good question. I want to say I think Cogent Bank was doing some stuff for a while. There was Synovus was one for a bit. I feel like when banks need loans, sometimes they just get a little bit more open and
Aggressive.
flexible. But there's never a go-to. I've even
Yeah.
had some of the credit unions were like, hey, we're light this month or this quarter. Hey, we'll look to do this one. So it just kind of depends. I'll try. If I have a client that's with me for a couple of years and they're ready, I'll try to put them in contact with 3 or 4 of my colleagues on the conventional side, and hopefully someone can figure something out there.
Yeah.
But I wish Bank United had a program too for a while where they were refinancing SBA loans, and then I think once they get their fill, they pull the plug on it. It's just timing is everything in our world. It's not fair,
Yes.
but it is what it is.
Yeah, and that's why I tell the guys you should always be talking to bankers. You
Yeah,
should always be networking with bankers. You never know when they get aggressive. You never know
right.
when they're, the bank that was aggressive last year could be conservative this year.
Yeah,
And
yep,
it's like it
exactly.
changes all the
It
time.
does change, and I don't know. I mean, again, we're in Tampa, so there's a local bank here in Tampa that was generally really aggressive, a competitor of ours, and they've had some issues recently, and they've kind of sold off or closed down a portion of their portfolio, and again, I still think they're going to be active, but maybe not as active, and it's
Right.
just to your point, it's always evolving, and we get a guy who maybe leaves the team and wants to start his own team somewhere. Well, he's going to
Yeah,
come out and he's gonna be aggressive. I mean, he's
that's
going to try
true.
to make his mark. So just
Yes.
stay close to it
Yeah,
because
you have a
it does
president
change.
that's get hired in a different company,
Yep.
and he made his mark on
Yep.
with SBA somewhere else, and he come all of a
Right.
sudden this is the biggest. And I tell the guys, if you find a program that's a strong program or an aggressive banker, you got to ride that thing as far
Absolutely.
as you can because it
Absolutely.
won't be there
Yep.
forever.
It's true. And
So
then, if you're like me, you do, you're a small bank, and then, you guys do good for a few years, they sell the bank, and now all of a sudden
yes.
everything changes. That's how it goes.
Yeah. So what's the question that I didn't ask? What's something that I didn't cover that you
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 covered a
come
lot of
across?
ground. I mean, we talked about the key changes, we talked about our approval, we talked about creative structures. Um, I guess maybe the one, not to ask, just one little tidbit of advice as we were talking, going back to the structuring. One thing I'll see is, sometimes with buyers, especially if it's their first kind of go around, they'll fall in love with the company and they'll spend a lot of time and money and they'll spin their wheels, and ultimately, they just can't get there because the numbers aren't right or the seller's not willing to budge or the values, the price is too high. I would just say, have a good team in place, know who your advisors are. If you're going to use an attorney, have your attorney there. And if you have a banker you can call or text or, run something for, it'll save you a lot of headache. Because, I'm working with, a couple of people now, and, they're maybe 4 or 5 weeks in due diligence and they just started talking, and it's like, guys, we're pretty far off. You're going to have to make a pretty substantial down payment to get these numbers to work. Math's
Oh
the
wow.
math. So, if they knew that up front, maybe they wouldn't have wasted 5 weeks.
Yeah.
So there's just that, that's the only thing. But no, I think all the questions are right on. I mean, you and I have worked directly together, and you were great, super sharp.
Appreciate
I
it.
don't
And
expect
I
anything less.
appreciate you're being fast, and that's what I tell the guys, by you as well, is like if you want someone that's responsive and fast and aggressive, call Craig.
I appreciate
I've
it.
talked to a lot of people, and it's not the same. So, and even within your bank, I've talked to
Right.
people within your bank that are not as what I mean, not as sharp. So I appreciate your responsiveness and your speed and your advice.
No worries.
Well, thank you for joining us, and hopefully we'll have you again. Maybe one day we'll have one of your underwriters. That'll be fun too.
Yeah, that'd be good. That'd be good.
Hear their
Be
story.
careful what you wish for on that. It might scare everybody.
I'd love to have one of those guys. Thank you. Appreciate it.
All right, take
have
care,
a good
guys.
one.
Have a great one.
Thanks, guys.
Thank
See ya.
you. Thank you. Bye.